What's an interest rate? The answer to that might seem obvious, but it is quite far from obvious by any means. Hi, I'm Doug Carroll from Insider's Guide to Finance, and I'm here today to try to clear up some of the many mysteries associated with exactly what an interest rate is. While the phrase interest rate might seem to convey obvious information, it doesn't, at least not without further clarification. If you identify a specific interest rate, like the 10-year T-note rate, or the 30-year mortgage rate, or the overnight Fed funds rate, at least to someone who's familiar with market conventions, identifying the rate actually conveys a lot of information. For instance, how you're going to account for the passage of time, so-called day count conventions. Is it actual days or 360 or actual over 360? It also informs about the frequency of compounding, whether it's semi-annual or monthly or daily. So identifying a specific rate, at least to someone familiar with the conventions, conveys a lot of information. But the phrase interest rate by itself is so vacuous, so widely open to interpretation, that without further information, it doesn't actually tell you a lot. And that's because there's a plethora of interest rates, and they have a wide variety of different uses and applications. For instance, interest rates might be used to determine the cash flows that are payable or receivable on a bond or a loan, a coupon rate or a loan interest rate. But interest rates are also used to make intertemporal comparisons, in other words, comparisons of value over time. Those are the time value of money applications of interest rates. So future values. What is the future worth of money in hand today? Or present value. What's the current worth of money payable or receivable at some point in the future? Interest rates are also used to price and value future cash flows, like the cash flows payable on a bond. Now note I said price and value. Those are, believe it or not, two different concepts, at least depending upon how one is defining terms. And while both pricing and valuation are finding the present value of a future stream of cash flows, you're using different interest rates. Pricing means discounting the future contractual cash flows on a bond by the yield to maturity expressed as a periodic rate. Valuation means estimating the value of these future cash flows, discounting the future cash flows by a vector of spot rates. That is, each individual contractual cash flow is being discounted by a spot rate that represents the timing and risk associated with that particular cash flow. Interest rates can also be used to express value. In other words, you can quote securities on a rate basis. And for that matter, rates of return are also based on interest rates. Note, quoted interest rates and rates of return are actually quite different concepts, but a rate of return is normally defined as the discount rate that equates the present value of the cash flows at some horizon, say the end of the period for which you're measuring returns, with the value of the portfolio at the beginning of the period. So interest rates have a wide variety of uses and applications, and in response to or in reaction to seeing or hearing the phrase interest rate, the first question one ought to ask themselves is exactly what is the purpose for which this interest rate is going to be used. And to tie the discussion back to the rates we introduced at the beginning of the video, the 10-year T-note rate, the 30-year mortgage rate, and the overnight Fed funds rate, all three of those rates imply different things about day count conventions, compounding frequencies, and their application. Normally, when you encounter the 10-year T-note rate, what's being quoted is the yield to maturity on that most recently issued 10-year Treasury security. And despite it often being defined otherwise, a yield to maturity is an interest rate that expresses the current value of the security. See the video on yield to maturity versus rates of return if you want to dig into the details on that distinction. On the other hand, the 30-year mortgage rate, that's a rate that would be used to determine the monthly cash flows at the initiation of the contract, and also would be used to determine what portion of each month's payment was going to be deemed interest that's due on the outstanding principal. And the last of the bunch, the overnight Fed funds rate, well, that was a function we didn't even introduce earlier. Now, there are two Fed funds rate. One's a market rate, and in which case that rate is both reflecting the price as well as the amount of interest payable on what is typically an overnight borrowing, but it's also a policy rate through which the Federal Reserve is attempting to influence the future course of economic activity. And each of those three rates use different day count conventions: actual days for the T-note, 30/360 for the mortgage, and actual over 360 for the Fed funds rate. And they also imply different compounding frequencies, respectively semi-annual, monthly, and daily. So interest rates are a potentially very confusing issue, and as much as it might seem obvious what the meaning is implied by the phrase interest rate, because of the wide variety of applications and uses for which interest rates are put, in reaction to being exposed to the idea of an interest rate, the first response ought to be exactly what is the purpose for which that interest rate is going to be used. I hope you enjoyed this video. You can go to our YouTube channel or Facebook page to see other videos on a range of investment-related topics. Or you can go to the website, insidersguidetofinance.com. At our website, in addition to the free video shorts, there are a series of modestly priced, in-depth training videos with running times of approximately 1 hour each that go into a number of subjects in greater detail. The website and Facebook page also contain information about open enrollment programs I will be presenting over the next few months, and my recently released book, The Insider's Guide to Fixed Income Securities and Markets.